Last year, 1.65 lakh taxpayers received income tax scrutiny notices, and that was 3 times more than the previous year. And the interesting thing is that these people were not trying to evade taxes. They were normal people like you and me who filed their taxes, who received the acknowledgement but did not receive their refund on time. So what went wrong? In this video, we will talk about 8 mistakes that people make while filing their ITR and some small checks that you should do in order to avoid getting a notice. So let's begin. Before we get into mistakes, let's quickly understand what scrutiny means. Because when a lot of people, when they see a notice, they start to panic without understanding what it actually says. See, when a scrutiny notice is issued by the income tax department, they are just trying to have a closer look at your returns. And this notice is issued under section 143 subsection 2. And it broadly looks at, did you underreport your income? Did you overclaim your losses? Or did you underpay for your taxes? And this notice can be served for up to 3 months from the end of the financial year in which you file your return. For example, you file your return in July 2026. So that financial year is from April 2026 to March 2027. So from that, 3 months after March 2027, which means that this notice can be served to you up till June 30th, 2027. Which means to say, if you file your ITR and you get that acknowledgement, does not mean your job is done. The process is still incomplete. What has changed recently is that IT department has built a data-driven automated system, or simply automated risk scoring system called as CAS, Computer Assisted Scrutiny Selection. Now, what it does is, it scans your returns and cross-checks it with data provided by your banker, employer, fund house, or any financial institutions. And if they see any irregularity, boom, you get the notice. See, it was not because someone was trying to intentionally evade taxes. It simply happened because the data which was available with the department mismatched with the returns that you reported while you were filing your taxes, which leads us to understanding the mistakes that we make. So let's begin with mistake number 1. If you are a salaried employee, then Form 16 is a very important document when you file your ITR. Think of Form 16 as a summary of your entire financial year. It consists of things like how much income you made that year, how much tax was deducted during that year, what were the deductions that you were eligible for, or how your tax was calculated overall. But there are mistakes in Form 16 as well. You see, when your HR gives you that Form 16, we assume that since it is coming from the HR, it will be correct. But that is not always the case. Let me give you an example. There is this guy Rahul who was working in company A from April to September, and October onwards he switched to company B. Now, while company B is going to collate that Form 16 for Rahul, for his 14 lakh income that year, they somehow did not account for the income that he made when he was working from April to September in company A. Now, this will create a mismatch because when Rahul's Form 16 will be submitted, the income tax department will be comparing that with AIS and Form 26AS. And that mismatch will create irregularity, red flag, which will ultimately be leading to a notice. Therefore, whenever you get your Form 16 from your HR, make sure that you also review it once before you finally submit for your filing returns. Now, we just mentioned about AIS and Form 26AS. Now, what are these? Let's understand in our next mistake of income and TDS mismatch. Now, AIS stand for Annual Information Statement. It's basically a report card that is prepared by the government even before you start filing for your taxes. It consists of all the data that is reported by your banker, employer, your broker, fund houses, or any other financial institution that you deal with in that particular year. And along with that, they also give the information about SFT, which is statement of financial transaction. Basically, if in that particular year you make large or high value transactions, for example, a large bank deposit or property sale or purchase deeds or some sale of stocks, credit card payments, etc. In these cases also, institutions are supposed to report these high value transactions to the income tax department. On the other hand, Form 26AS is slightly different. While AIS provides a broader picture with regards to your financial activities, Form 26AS primarily provides you picture about your tax deducted or collected and then deposited against your PAN, basically TDS or TCS. Now here's why they matter the most. Because when you file your return, then the government is comparing the information that is provided by you with the information that is already stored in the system. Let's say you have an FD interest of 18,000 which you forgot to file during your ITR. But your bank reported to the government that you have made the interest of 18,000, which means that there is a mismatch in reporting. Or let's just say that your employer deducted TDS of 70,000 rupees. But your Form 26AS shows it as 50,000 rupees. Now again, there is a reporting mismatch. Now while you file your ITR, you need to ensure that all three forms, Form 16, AIS and Form 26AS, they reconcile with each other and all three are telling the same story. Now the next mistake is related to high value transactions. Cash deposit, property purchase, stock market activity, credit card spendings or FD openings. All of it is tracked, reported and stored against your PAN. Remember we talked about SFTs? Today, large financial transactions leave digital trails and all these transactions find their way through various channels to reach to the income tax department. If there is any transaction that is above a certain specific threshold, then that is reported to the income tax department by institutions like bank, broker, employer, or other institutions that we deal with. For instance, if there is a cash deposit of 10 lakh or more in a savings account in a financial year, or if there is a property purchase of 30 lakhs or more, or if there is a credit card spend of 1 lakh or more in cash, or 10 lakh or more under other modes or methods in a financial year, then that needs to be reported. None of these activities are illegal. The issue arises when these transactions are inconsistent with regards to the income for which you have filed the return. The income tax department wants to understand where did the income came for these activities. Was it some additional income? Was it loan? Was it inheritance? Was it some other income that was not accounted for? See, the mistake that people or the taxpayer make is that they believe that these all are legitimate activities. Therefore, even if they go unreported, there's nothing wrong. The only thing is that if a major transaction appears in a database, then there should be some supporting explanation or documentation against it so that there is no mismatch. If the money is moving, it needs to show somewhere else and it should have a proper paper trail. Now, this is the mistake that catches most responsible taxpayer as well off guard because people forget to file their total income in their ITRs. Now, by that we mean is that people file their ITR which includes their salary but not the total income, and the income tax department is concerned with your total income. And salary is a part of your total income. Now, what does that mean? For example, Anjali has a salary of 14 lakhs, but along with that, in that financial year, she also earns 12,000 from her FD interest, 8,000 she earns from her dividend income, and 60,000 she made from a freelancing activity. Now her total income is 14 lakh 80,000, whereas her salary is only 14 lakhs. Now, if she files the ITR for only 14 lakhs, then that will create a mismatch. Why? Because her banker is going to report that 12,000 FD interest, her broker is going to report her 8,000 dividend income, and the company for which she might have done that freelancing work will have raised a TDS for that 60,000 income that she made. For that 80,000 rupees gap, the income tax department sees that as a red flag and a mismatch. So these are the sources that you must report even if the amount is small. And if you have traded or invested in the stock and made some capital gains, do not forget to report those as well. If you make losses, then those also should be reported. To make this easier, keep your tax P&L report, contract notes, trade book, annual global statement, and other transaction records handy while filing. If you are a Zerodha customer, you can download these reports directly from console, which can help you accurately report your gains, losses, dividends, and other investment-related income. Also, you can use online tools to calculate your capital gain tax. Now, this mistake is often overlooked. Let's say you were making 18 lakh per year last year, but this year you actually had an income of 9 lakh per year. Now, what was the reason for that sudden fall? Income tax department wants to know that. Did you leave your job, switch your career, took a break, or did your business face some losses? Ultimately, the government wants to understand the reason behind it, and they want you to support it with valid documents. These documents could include revised salary slip or job termination letter, income statement, business record, or any other financial document that supports the reason of the fall in your income. Now, for the next mistake, that might sound minor, but that can unnecessarily create complications, and that is choosing the wrong ITR form. Now, to give you an example, let's say Rohan is a salaried employee, but along with that, he made certain short-term capital gain in that particular year. Now, he chose ITR Form 1 to file his return because that is what he generally chooses. But the only problem is that ITR Form 1 is not the ideal form when you have such capital gains. Now, this will create a certain problem because the reporting of such taxes will not happen properly. Similarly, imagine a freelancer graphic designer choosing ITR Form 4 even though such forms are not meant to record such incomes. Or maybe a professional businessman choosing for a form which is ideally meant for salaried employees. See, the issue is not with the form. The issue is that certain forms are made in a way so that they capture the income properly and correctly. When you choose a wrong ITR form, then that income is not reported properly, which can later lead to mismatches. If you are unsure which ITR form applies to you, don't just guess. There are online tools available that can help you identify the correct form based on your financial sources and filing requirements. Remember, filing quickly is not the goal, filing correctly is the goal. Now, for the next mistake, people assume that since TDS was deducted by the employer, therefore they are not supposed to file the ITR. Or if they think that they do not have to pay any additional tax, thus they should not file the ITR. Or there are people who think that since they do not come into the taxable bracket, therefore they are not supposed to file the ITR. But all these three situations are not true. Ideally, you are supposed to file the ITR if following of the three is true. Number 1, the individuals whose income is above the exempted limit, or the residents who have foreign assets or have authority over foreign bank accounts, or you have to file your ITR even though your employer deducts the TDS. For the last mistake, many taxpayers think that once they click on the submit button, their job is done. But there is one last step that they need to do, and that is e-verification. E-verification is how you confirm to the income tax department that the ITR was filed against your PAN and it was filed by you or under your knowledge. It acts basically as a digital authentication. And remember, ITR needs to be e-verified within 30 days. If you fail to do so, then your application is still invalid and does not get processed. Basically, your application will be showing under pending status. The good news is that e-verification takes just a few minutes and can be done through any of these methods. Now, what if, even though you followed all these points, but still you got the tax notice? First of all, don't panic. Getting the tax notice does not necessarily mean that you have done anything wrong. Just follow this process and that will help you get through it. The first step is to carefully verify the notice. Make sure that it is issued by the income tax department and also has a document identification number. A lot of tax-related scams are rising these days, so verification becomes very important. The next step is to identify why the notice was issued. The section under which the notice is issued generally gives you a clue for the reason behind it. Was it related to defective returns, certain scrutiny assessment, or certain clarification is needed with regards to a transaction or income disclosure? Once you have identified the concern, gather all these relevant documents. If the matter still appears complicated and you are unable to solve it yourself, in such cases, seeking help from a tax expert is a right decision. And lastly, most importantly, do not forget the timelines. Such notices often come with a strict timelines. Make sure that you revert to the income tax department within a stipulated time. Also, a quick thank you to Quico for reviewing and validating the technical aspects of the video. We have covered so much in this video. Let's quickly understand a few key takeaways. First, make sure you report all sources of income and not just your salary. That could include interest income, dividend income, capital gains, and any other earnings during the year. Second, always reconcile your information with AIS and Form 26AS before filing. Third, don't ignore high-value transactions. If you've made significant investments, property purchases, or large financial transactions during the year, make sure your tax records tell a complete story. Fourth, avoid last-minute filing. Most mistakes happen when people rush through the process just a few hours before the deadline. And finally, choose the correct tax regime and correct ITR form based on your financial situation. A little extra effort before filing can save a lot of time and stress later. Filing your ITR is not just about submitting a form. It's basically telling the income tax department an accurate, complete, and consistent story about your financial journey in the year. For more such financial concepts and insights, do watch our regional channels as well. I hope you liked this video. See you in the next one. Until then, happy investing.